Welcome back to the deep dive. We're here to, crack open those complex topics and give you the insights you need fast. Today, we're really plunging into the pretty intricate world of financial markets, specifically an advanced liquidity trading strategy. And this isn't just about making money. It's more about understanding the hidden mechanics, right? Helping you sidestep common pitfalls and hopefully significantly improves your trading accuracy.
Definitely. Financial markets are, well, they're a labyrinth. Always moving, always changing.
Exactly. And as traders, we're constantly searching for that edge, that strategy that finally makes sense of the chaos, maybe puts us ahead. So our mission today is to expose the secrets of hidden liquidity in the market. And crucially, to unravel how the big players, the institutional traders, actually use the actions of us, the retail traders, to their advantage. We've dug into some great sources for this deep research, articles on advanced trading techniques, stuff that reveals these market dynamics that often get overlooked.
It really is fascinating, isn't it? How often what seems like the obvious path in trading just leads straight to, well, frustration. Because liquidity, it isn't just about how easily you can buy or sell an asset. In trading terms, it primarily refers to a concentration of orders, usually stop losses, buy stops, sell stops. And these aren't just random points on a chart. They act like magnets for price action. Their presence has a huge bearing on whether you win or lose a trade. Today, we're specifically going to unpack two common forms, equal high and equal low liquidity, which really just refer to familiar support and resistance levels and also ascending and descending trend lines.
Right. And this is exactly where the plot thickens for so many retail traders.
Yeah.
I mean, I remember this clearly from my early days. See, the general trading education out there often suggests a really straightforward approach. Spot a resistance level, sell the resistance. Simple. You know the drill, right? Market taps the level once, maybe twice, retreats. Any touch after that looks like a prime selling point. The logic feels sound. You sell, pop your stop loss just above that resistance, and you expect the market to respect the level and head down.
Right.
But here's the twist, the crucial part. That very assumption, the idea that the resistance will hold, that's exactly what the big players prey on.
Precisely. And if we connect this to the bigger picture, think about institutional traders. They often find it incredibly difficult to sell huge volumes below an obvious resistance level. Why? Because doing so would push the price down too quickly against them. They get a really poor average price for their massive orders.
Okay, that makes sense. So they can't just dump their shares there.
Exactly. So what do? They wait. They know that just above those equal highs, that resistance level, there's a massive cluster of retail traders' stop-loss orders. And here's the critical insight. A stop-loss on a short trade, a sell trade, is actually an automatic buy order. It has to be to close the position.
Ah, okay. So selling pressure hits stops, which turn into buy orders.
Right, but it gets even more interesting. Think about breakout traders. They're looking to buy above resistance, expecting a break, and then maybe a retest for a continuation higher. So they also place buy stop orders up there, ready for the breakout.
So you've got stops from sellers and entry orders from buyers all clustered together.
Exactly. This mixed stop losses from sellers being hit, buy stop orders from breakout traders being triggered creates what we call buy-side liquidity. It's this huge tempting pool of buy orders just sitting there above resistance. Now, when the market pushes up and triggers all this buying activity, suddenly the big players have abundant liquidity to sell into. They can execute their large sell orders at a much better average price because there are so many buyers available at that moment. Wow.
Okay.
This calculated process is what we define as a liquidity sweep, or, what most people call a false breakout. The market pushes up, stops out everyone who sold the resistance, and simultaneously triggers the breakout buyers into the market. Then, with all that buying momentum suddenly absorbed, the big player steps in, sells heavily into it, and drives the market down hard.
Right. And that's the moment.
That's the moment. And in this scenario, retail traders often find themselves stopped out, taking a loss, literally moments before the market finally moves in the direction they originally anticipated.
Oh, it's infuriating. You get stopped out, watch the market tank, and think, I knew it was going down.
Yeah.
Just without you in the trade. I remember feeling like the market was personally hunting my stops sometimes. It's a common feeling, I think.
Very common.
And get this. It's not just resistance. Equal lows work in precisely the same way, right?
Exactly the same principle, just flipped. Below a clear support level, you'll find a massive amount of sell liquidity. This comes from stop losses placed by traders who bought at support. Those stops are automatic sell orders. And also sell stop orders from breakout traders expecting a break downwards.
Okay, so the institutions wanting to buy wait for that.
They wait. They wait for the market to dip down, trigger all this sell liquidity below the support, and then they step in and buy huge volumes, absorbing the selling and driving the market up.
And trend lines, too, you mentioned.
Trend lines as well. Instead of a nice clean test or a clear break retest that retail traders often look for, we frequently see the market sweep the trend line. It momentarily breaks it, takes out all that clustered liquidity, stops from people trading the trend, entries from people trading the break before resuming in the expected direction.
So the main flaw in that traditional retail thinking becomes glaringly obvious then. Blindly buying from support and selling from resistance, well, it seems like a sensible strategy.
It has a fundamental flaw.
Yeah. Because the big players, the institutions with market-driving power, they aren't executing at these super obvious levels. They're executing above resistance and below support.
Using the retail order flow to facilitate their own larger positions. That's the key takeaway.
Okay. So we've exposed these classic liquidity traps. Now, how do we actually navigate them? You mentioned advanced concepts.
Right. Let's arm ourselves with two crucial advanced concepts that help us, well, hopefully outsmart these market maneuvers. Inducements and confirmation, specifically around supply and demand zones. Now, while these are all part of, smart money concepts trading, it's really crucial to be aware of how liquidity concentrates around these supply and demand areas.
Yeah.
A supply zone, simply put, is an area where traders expect selling pressure, maybe where price fell sharply before. They want to sell when the market returns there.
Okay, standard supply zone.
Yeah. Now, an inducement in this specific context happens when the market enters that supply zone and then maybe forms equal highs or a clear double top within that zone.
Right, looks like a reversal signal.
Exactly. It looks like a perfect place to sell, but it's essentially a lure. Other traders are enticed to sell that apparent reversal before the market makes its real move, which might involve sweeping those highs first.
So if I sell that double top inside the supply zone,
The inherent risk, is that the market pushes up just a little bit further to take out those equal highs, grabbing all those stop losses clustered just above before it makes its actual intended sell move downwards.
so you get stopped out prematurely.
You can fall right into that inducement trap.
Okay, so the market can basically paint a pretty picture to lure you in, just to run the stops before the real move. That's subtle.
It is subtle but powerful.
And it gets even more complicated, doesn't it? Because you often have multiple potential supplier demand zones stacked near each other.
That's another major challenge. You might have, say, 2 or 3 potential supply zones relatively close together.
So what does that mean in practice? Even if the market reacts a bit to the first lower supply zone, showing some initial weakness.
Right, even if it seems like it's working. There could still be an area of significant liquidity, maybe what we call an imbalance, further above, and that higher area might have a very high likelihood of being tagged or swept.
So the market might just push through the first zone to get to a better one higher up?
Exactly. It might extend into a higher supply zone to clear out even more liquidity before making a significant sustained move down. So just looking at the first zone isn't enough. You need that broader context.
Okay, this sounds tricky. So how do we actually combat this? How do we avoid getting liquidated by these inducements or picking the wrong zone?
This is where the solution comes in, and it's the core principle of effective institutional style trading, what I call standard confirmation. It's not some brand new secret concept, but it's about focusing intently on observing a clear structural shift in the price action. This helps validate your trade idea and dramatically increases the probability of success.
A structural shift. Okay, what does that look like?
So, standard confirmation shows us a clear change in control. For instance, from buying pressure to selling pressure, or vice versa. Let's visualize it. If the market is clearly in an uptrend, making higher highs and higher lows consistently, a genuine shift in control to the downside would involve the market breaking below a previous significant low. It needs to make a lower low.
Right, breaking the pattern.
Precisely. That break signals that sellers have likely taken over, at least temporarily. Only after seeing that lower low form would we then look to sell, perhaps from the next lower high that forms on a pullback.
I see. So you're waiting for proof of the turn, not just guessing at a level.
Exactly. This approach is incredibly powerful because it gives you objective evidence of a change in market control. Now, contrast that with our earlier example of equal highs within a supply zone. If you just sell those equal highs blindly, well, you haven't seen that clear shift yet, have you? The underlying buying pressure might still be dominant.
No, you haven't. You're just hoping the level holds.
Right. The market might push up, take out the liquidity above those highs, and then finally show you that structural shift with a proper lower low. So by waiting for this standard confirmation, by aligning, say, a smaller time frame trend reversal, the structural shift, with the larger time frame anticipated bearish move, you transform a speculative guess into a genuine high probability trade.
Okay, that makes a lot of sense. Patience pays off.
Waiting for confirmation helps you avoid selling blindly just below resistance or buying blindly just above support. It will save you from countless unnecessary losses. It's about objective evidence, not just reacting to where the price is.
That structural shift idea,
Yeah,
it really is a game changer. It shifts your whole perspective from just watching price levels to trying to understand the hidden order flow, the intention behind the move.
that's it exactly.
All right, theory is great, super insightful. But let's try and make this concrete. Let's look at a real market example. We're going to pull up the Euro Swiss franc, let's say, on a 5-minute time frame.
Yeah.
But remember, like you said, this concept works on basically all time frames because it's fundamentally about supply, demand, and how liquidity is engineered.
Correct.
So imagine a scenario. The market's just started moving up, it pulls back, retests the demand zone, looks good, and then pushes up to make a new high. Now you're looking for the next buying opportunity on a pullback. But here's the problem we discussed. You might see multiple potential demand zones within this recent upward range. Each one looks like a possible entry.
Exactly. And the challenge for many traders is precisely this: choosing the correct demand zone and avoiding being liquidated by those lower zones that are actually just inducement traps. So in our hypothetical Euro Swiss franc example, let's say as the market moved up, we can identify 3 potential demand zones left behind: Zone 1, Zone 2, and Zone 3, the lowest one or the extreme.
Okay, 3 possible entries.
Right. Now, applying our logic, the key here is we probably won't just place a buy limit order at the first highest zone. Why? Let's say looking closely below Zone 1, we can still see clear imbalance. Remember, imbalance is that inefficient price delivery, like a gap or vacuum where price moved very quickly. It often acts like a magnet.
Okay, so there's unfinished business below Zone 1.
Potentially, yes. And
Yeah.
in our example, let's say the market does indeed ignore Zone 1, pushes lower, liquidates any early buyers there, and fills some of that imbalance. This demonstrates Zone 1 wasn't the true point of institutional interest.
So skipping Zone 1 saved us a loss. What about Zone 2?
Same logic applies. Let's say the market dips into Zone 2, maybe bounces a little, but critically, it doesn't give us that clear standard confirmation, that break of structure to the upside on a smaller time frame, perhaps. And maybe below Zone 2, there's still some remaining imbalance before we reach Zone 3. This signals that the market likely still intends to push lower.
So those first 2 zones, even though they look like decent pullback entries on the surface, were essentially liquidity traps, designed to catch early buyers before the real move from the lower zone.
That's often how they function, yes. They induce buying interest prematurely.
It really hammers home the idea of patience, doesn't it? If you're rushing in, setting buy limits at those first zones as soon as price touches them.
You're opening yourself right up to that inducement theory. You risk getting stopped out, even if your overall prediction that the market will go up is eventually correct. You just got in too early at the wrong spot.
Okay, so we've avoided Zone 1 and Zone 2. What happens at Zone 3, the lowest one?
Right. This is the critical moment where the strategy really shines. Let's assume Zone 3 is the extreme demand zone, perhaps the origin of the whole upward move. This is where the true institutional buying interest is most likely located. Now, imagine price finally reaches Zone 3. What we're looking for now is that crucial shift in the trend, our confirmation. Specifically, after price hits Zone 3 and starts to bounce, we want to see a break of structure, or BOS, to the upside. Meaning price needs to break above a recent significant high that was formed during the pullback.
Ah, the confirmation signal.
Exactly. That break of structure signifies that the buyers stepping in at Zone 3 are strong enough to overcome the recent selling pressure. It validates the demand zone and signals a change in market control back to the buyers.
So once that BOS happens, that's our cue.
That is our confirmation. Now we can confidently look for buying opportunities using this validated Zone 3 demand area because the market has finally shown its hand. Control has shifted.
And you mentioned finding opportunity within opportunity. How does that fit in?
Yeah, right. So once you have this higher time frame confirmation price hitting Zone 3 and breaking structure, you can often drill down to an even lower time frame, maybe the 1-minute chart. And if you break down the price action within that confirmed Zone 3 area on the lower time frame, guess what? You'll often see almost the exact same pattern playing out again, just smaller.
Like Russian dolls.
Exactly like Russian dolls. You might see multiple tiny demand zones created as price initially reacts off zone 3. And again, the inducement theory is still at play even on this micro level.
So even within the good zone, there might be smaller traps.
Precisely. You might see a tiny initial reaction zone form, but maybe there's still a little imbalance just below it within the larger zone 3. So you wouldn't necessarily jump in on the very first tiny bounce.
You're still waiting for confirmation, even on the lower time frame.
Ideally, yes, or waiting for price to mitigate any remaining inefficiency. You wait for the market perhaps to sweep those tiny initial inducement lows within zone 3 and tap into the most refined point of interest, the origin of the lower time frame push.
Okay, so it's about precision.
It's about precision and confluence. Once the market reaches that deeper, confirmed point within zone 3, and then you see a clear break of structure on your operating time frame, maybe the 1 minute or 5 minute. Especially if that push-up creates an efficient range, meaning it clears out any immediate imbalances or obvious liquidity pools sitting just above.
Then you're good to go.
Then, yes, you can confidently look to buy that market. Why? Because you've waited for multiple layers of confirmation. You've seen the higher time frame zone hold. You've seen the structural shift. You've potentially seen lower time frame refinement and another break. The path of least resistance is now likely upwards.
So the final trade setup would be?
A buy limit placed perhaps at that refined entry point within zone 3, maybe on a pullback after the lower time frame BOS. Your stop loss goes safely below the low of zone 3 and your target. Aiming for those new highs that the market is now likely to seek, capitalizing on that confirmed shift in control.
Okay, let's quickly recap that whole example because it ties everything together beautifully. We saw multiple potential demand zones. We patiently avoided the first two, the higher ones, because they lacked confirmation and likely served as inducement. That saved us from potential losses right off the bat.
Correct. Patience is key.
Then we waited for price to reach the lowest extreme zone. We didn't just buy it blindly. We waited for that definitive confirmation, the break of structure proving buyers were in control. We might have even refined the entry on a lower time frame, waiting for another sweep or BOS there. We played it safe, waiting for all the pieces to align.
Ensuring the highest probability.
Right. And now, by doing all that, we're entering what is basically the safest possible trade under these conditions. The market gives that pullback, the refined demand zone gets filled, and then boom, we get that powerful drive to the upside.
Taking out the previous highs.
Taking out the highs, leading to a potentially great trade. It really shows the power of waiting for confirmation and understanding these deeper liquidity mechanics. It's not about predicting, it's about reacting to confirmation.
Absolutely. And ultimately, this whole process, this entry model, it's designed to help you avoid falling prey to that inducement theory. It's about making sure you don't get stopped out on trades that, frankly, with a bit more patience and insight, could easily have been winners. It boils down to understanding the true mechanics of how liquidity works, how institutions operate, and then patiently waiting for clear, objective confirmation of a structural shift. Stop trying to guess the exact turning point at obvious levels.
Align yourself with the smart money, rather than becoming their exit liquidity.
That's a perfect way to put it.
So wrapping this up, what does all of this really mean for you, the listener, the individual investor or trader tuning in? Today, I think we've really peeled back the curtain a bit. We've seen that liquidity in the market isn't just some abstract concept about volume. It's often an invisible battlefield, a place where the big players strategically and predictably exploit the common assumptions of retail traders. So the question I want to leave you with is this. In your own trading or investing, what kind of hidden liquidity dynamics might you be overlooking right now? Are you inadvertently falling into these situations we described, where the market seems to stop you out just before making the move you anticipated? Think about that. Consider how deeply understanding these institutional plays, these concepts of inducement and confirmation, could fundamentally transform your entire approach to the markets. It could give you a distinct, powerful edge, something to definitely mull over. Until the next deep dive, keep learning, keep growing. And hey, if you enjoyed this deep dive and found it valuable, please make sure to follow us wherever you get your deep dives.
We really love bringing you these insights, and your support genuinely means the world to us. Thanks for tuning in.